Welcome to the Shadow MPC with Clive Owen LLP, Recognition PR and the Northern Echo. We discuss interest rates and people's business outlooks before the real MPC of the Bank of England makes real decisions on what interest rates should be. We know that the North East has 2 clubs in the Championship playoffs, but do our members think that the region's economy is Premier League? Retail sales increased by 5.2% on a like-for-like basis in April compared to the same period a year earlier, according to data from the British Retail Consortium and consultancy KPMG. But that headline growth in retail sales, which is not adjusted for inflation, masks slumping volumes in food and non-food sales. Inflation is stuck in double digits at 10.1% and has fallen more slowly than expected. The European Central Bank last raised interest rates just last week again to maintain its battle against inflation, but eased the pace of increase to 0.25 points to 3.25%. Also, the Americans raised interest rates by the same amount, 0.25%. So what does that mean for the North East and UK economies? Let's ask the members of our Shadow MPC. Let's talk first to Paul Gibson. Paul, you're from Active Chartered Financial Planners. You advise people on their wealth and managing their money. What do you think the outlook for interest rates should be now? Not what do you think it will be, but what do you think it should be?
I think, you've mentioned a few things in your introduction there, Graham, around inflation not coming down as quickly as we think it should. So what I think is rates should try and stay where they are, possibly keep a little bit higher. We're in a real danger of probably levelling out, and what I don't want to see is interest rates come down too soon. What we tend to find here is that there is a lag effect, which I think we're just seeing with some of these banks globally, Credit Suisse, banks in the US starting to go bust or have problems. And that's despite these rates going up over the last 6 to 7 months. There's a bit of a lag effect on that. I think really from the other side of our business, advising clients after a very tough 2022 to focus on one positive, we are starting to see a pullback in portfolios. So in isolation, 2022 was the worst year on record for nearly 100 years. But it's pleasing to see that's coming back slowly. We do advise clients with mortgages. And what we're now seeing is some of those clients are starting to come off fixed rate mortgages. And I think that pain of additional payments, new rates are going to have to pay, will be filtering through in the coming months as well.
And that's the lag effect you were talking about, isn't it?
It is, yeah. So again, we're just starting to see people. Again, we advise on mortgages. We're starting to see clients come in, fixed rates are finishing. They are taking a sharp intake of breath when we're trying to rebroker mortgages on an independent basis, thinking, wow, from what they've been used to paying for the past 3 to 5 years on fixed rates. Per 100,000 borrowed, we're typically seeing additional payments of £250 to £300 a month. That's the reality of the rate increase that we've seen, and such a sharp increase over the last 12 months.
And there are other things that are coming down to balance the interest rates, aren't there? I filled up at the pumps to my diesel car and it had come down to just over 150 per litre, when just a couple of weeks ago it was the high 160s and a few months ago it was 170s. So there are actually other things that are coming down, and presumably that will affect domestic fuel and utilities.
Yeah, absolutely. And again, I was looking at the Office of National Statistics back in the March figures, and we're looking at electricity up 66%, gas up 130%. These raw material prices are starting to come down, and with the lag effect that we keep talking about, they can't simply go up another 130% in the next 12 months. So we're seeing raw materials starting to fall, and I'm sure that will filter through in the CPI figures. It's just taken a little bit longer to start to showing those results, but I'm sure it'll start to come as we get towards Q3 and Q4 of 2023.
Because you have a more roving financial brief with your business, I'm going to ask you this question. Obviously, these interest rates can't be taken in isolation for Britain. They are for Britain to get inflation down, but the interest rates in other countries affect it. Both the EU and the US did go for an increase, all right, a modest one, the slower rate of increase, but that surely affects what our increase should be. We don't want to import inflation by weakening the pound.
Correct. Yeah, I think we have to increase interest rates. I know we'll come into that at the end, but if we don't, we'll see sterling tank. We saw that back end of last year with the Liz Truss effect when that happened. We've got to be keeping pace with the US and the ECB and follow suit, really, because we don't, the sterling will certainly be affected.
Okay, we're on a little longer with you than the others, so let's go to the next one. We got Martin Pullen. Now, Martin is from FRP Advisory. It's an insolvency advisory practice. I think the starting point for your contribution would ask you what the level of inquiries is for you, because if you're busy, that's not necessarily good. For you it is, not for us.
True, yeah. We deal with businesses that have got a problem, and I think their main problem historically has been employees. It's moved on to those inflationary pressures on business, such as those energy costs rising. We're now seeing it being a pressure on borrowing. Debt servicing seems to be a challenge. My concern with, the level of interest rates, we talk about that lag effect. I'm going to look at that from a business point of view. Refinancing now is becoming more expensive. We've got challenges, I think, for businesses with recruitment as well. A lot of the businesses that feel the pinch of a contraction or challenging times when consumer spending starts to fall are those sort of retail, hospitality, leisure businesses who've had a pretty torrid time the last 3 years. I still think interest rates will need to increase to try and curb some of that spending. It's not fallen away as quickly as I think many would have thought. But those mortgages that are coming up for renewal are going to, increase the burden on households and on businesses. We've got energy contracts that were signed in different times that are, going to need to be renewed. And even though energy prices have fallen, they are higher than they were when they first contracted, say, 3-4 years ago. And that's going to impact as well. So it's a challenging time for business. It's a challenging time for consumers. But for a number of reasons, I still feel that a rate increase is probably needed.
Martin, can I ask you? I think you're probably the right person to ask this question, Martin. Banks and bank refinancings are happening routinely because they do. You have to refinance your bank borrowings. But with COVID loans expiring, quite often I've come across at least 3 cases now in Recognition's own client zone where a business has gone to the bank for its routine refinancing, but in the refinancing period, the COVID loan is about to come up for refinancing, and the bank has insisted on rolling them both together. Even though they're not both due, they'll roll them both together, and that affects their loan to value, the amount they can borrow.
Yeah, so the challenge at the moment is that, we're going to wider things here. The US Fed at the moment is warning of a credit crunch. We've seen a number of funders that are tertiary lenders in the UK have retracted from the UK, from Canada and the US. So as much as there are plenty of liquidity out there, it is more costly, and I think banks are being more selective. The CBILS, I think the CBILS environment and bounce back loans, businesses were used to very cheap debt, and it was absolutely needed at the time. We're now moving into a much higher debt environment, a much higher cost. Looking at some of the deals I've seen around at the moment are quite well. If you were forecasting a business opportunity, you're coming to refinance only sort of 4 months later than you were. I'm looking at the first 4 months of this year. That cost of debt has risen quite significantly as the banks start to price in rate rises already. So yeah, the burden of debt and the cost of debt is increasing. That's probably going to limit or going to reduce investment. That's going to add into our whole productivity challenge in the UK. So we've just got to be a bit careful with rate rises. And I do feel that, the lag effect is the thing for me. A small rise, and let's see where we get to in 3 to 6 months' time, and let some of these effects flow through, I think would be.
Okay, Martin, that's very helpful, very helpful. Let's move to Simon Hook from Clive Owen, our co-sponsor. Simon, good to speak to you. What's your client base saying? What's your evaluation of where we are?
Yes, thanks, Graham. So in terms of our client base, we offer services to a wide range of businesses, and everyone's saying the same thing really. They expected inflation to maybe reduce slightly quicker than it has done, which has caused some worry throughout the client base. I think what's happening, if we look at a set of accounts across the board, we're certainly seeing turnovers up for most businesses because they've had to put fees or costs up to cope with the increased costs, but profits staying the same. So margins are really being hit across the board, and people are worried out there because they know they have to get the turnover up to continue to meet these increased costs. But to do that, they need good recruitment, and the recruitment market, I think, as Martin said, is very, very difficult as well. So it's a bit of a double whammy, really, of trying to sort this out. So, yeah, I think people, would support more slight increase in interest rates, because I think that has to happen to continue to tackle the inflation. I just don't think it's going to go away anytime soon. But again, it is still very difficult out there. And, Martin, I've spoken to you before about this. The insolvency practitioners are very busy at the moment, and that does show what's happening out there, and certainly the ones we're seeing at the moment in terms of general advice is not so much about, tax planning, etc. It's more about how we can, cut costs in the business or grow turnover.
All right. Well, we love Martin very much, but we don't want him to be quite that busy. Let's move on to Tim Bailey from Excite Architecture, based in the North East, designing all sorts of things from stylish housing to commercial property. Where do you see things? Is your order book busy? Because it's a big forward future confidence in the economy, whether you're designing new buildings.
Yeah, that's right, Graham. The order book is fairly full, but there is a but about that, which is that it's principally to do with feasibility studies and sort of testing ground rather than projects that are going to run through their full course. And what's dampening that significantly is confidence in capital investment in development and potentially cost of borrowing as well. There's a serious lag from what the expectation is, whether it be rentals or pricing in the housing market, to cost of borrowing now for development, which might come on stream in 12 or 24 months' time. So that's a major dampening in our own workload. I think as significantly is the forecast for the construction industry as a whole, which has been downgraded in the first quarter from 4.7% to 6.4% drops. That's primarily not anymore to do with material supply, but is to do with labour shortage, as others have mentioned. It is also to do with confidence in what is inevitably a long-term investment process. So the industry is very hard to read at the moment. There is pockets of confidence. There is some real hesitation, and where this region sits is predominantly more in the second part of that.
So we just avoid any kind of thought about groupthink. When you look at evidence, if you were on the real MPC, would you pause, or would the other elements that have been discussed today convince you should raise rates a little?
Yeah, I'm at the moment, I'm certainly sat with a small raise, persuadable that standstill for another quarter would be okay.
But you're not wanting to do the persuading?
No.
All right, moving on. Thank you very much. Thank you. Let's move on to the next contributor, who is Martin Williamson from Latimer Hinks. Latimer Hinks do a lot of conveyancing, and Martin's the man. He does the conveyancing for mostly domestic property, but commercial as well. Is it still lively out there when it comes to domestic property transactions?
It depends which part of the market you're looking at, Graham. The bottom end of the market is struggling, but the higher end, middle to higher end, particularly the higher end, it's still relatively buoyant. There are still many transactions out there. Okay. Prices are not suffering in the way people thought they would do. I think this is mainly to do with supply and demand. There's still a shortage of properties, and that's keeping sellers confident that they're going to realise the sort of price that they were hoping to, and stopping them from accepting, the reduced offers that are being made these days. So yeah, it's more than two halves, if there can be such a thing. Bottom end of the market not doing so well, not at all. But the higher priced property is still moving.
And what's your view on rates? Surely rates will eventually have an impact on this, because people have to take out new mortgages if they are moving house. It's not as if you can keep it, is it? Very few of them are portable.
It's the cost of borrowing that's hitting the lower end of the market. I think and this is where perhaps a a rate rise of another 0.25%, it could be sustained at the higher end of the market because there's still the money there and there's still the confidence. And the interest rate hikes that we've had haven't really deterred those. So they've still got disposable income and are still, employed in good jobs.
And what's your view? Where do you sit on this? Are you a pause man? Are you a increase man?
Well, I was listening very intently to what Tim said. I think the market will take another 0.25%, and I think for all the reasons that have been mentioned, that's probably the way to go. But I wouldn't be too concerned if things stayed as they are.
Okay, thank you. And you don't want to advocate for keeping them they are?
No, I don't think so.
Okay. Let's move to Chris Donaby. Now, Chris is involved in a different type of property. He's a commercial agent for commercial property in the north of England at Naylor's Gavin Black. Where's your market sitting at the moment, Chris, and what would you like rates to do?
Yeah, Graham, we so as a commercial property practice, we act for landlords, developers, tenants, so different impacts on each, really. Landlords are working with their tenants at the moment, particularly those that are subject to higher energy costs. That's impacting on the occupancy market. Landlords who are subject to borrowing are looking at the refinancing and the impacts moving forward, the cost of debt. Developers, on the other hand, are looking to provide new properties for occupiers, offices or particularly industrial, which has been a strong market. Build cost inflation has been rampant over the last few years, and now the cost of debt has risen. So it's the viability issue that developers are seeing, and potentially a hiatus in actually developing and providing new required buildings into the marketplace. If we, as a country, are going to get up the productivity table compared to other G7 nations, we need the right buildings for those manufacturers. And we won't produce them at the moment with higher interest rates. So there's some wider issues at play there.
I think I might have found on this panel the first person that's going to say don't put them up. Where are you?
I would say pause at the moment. I don't think the pain of the recent hikes has washed through fully into the commercial property market as yet. I think pause and assess for now. I'm conscious I'm probably the only one that's saying that so far.
You never know. We've got David Coates coming next. He's got his finger on the pulse. Let's talk to him. David, you've got the advertisers that are queuing up to be in your paper and online. Is demand buoyant? Where do you see the market? What do you think on rates?
Well, this quarter's been a lot stronger than we expected. We anticipated the first quarter of this year to be quite tough going with what's going on in the with a higher interest rate environment. We thought that confidence would be impacted by that, but we haven't seen it yet. I think things are tightening up a little as we go into the second quarter and head towards the half-year point. I think customers are. I think the double bank holidays have had an impact on our business because customers are saying there's going to be so much disruption and therefore they're not committing to advertising campaigns over the disrupted period. So I think it's more sort of practical issues that seem to be getting in the way at the moment. But
I did see some good advertising around the coronation on some of your editions. God save the king from a carpet sales business and everything.
Absolutely, those old techniques still work in the modern environment. But yeah, I think things have been better than we anticipated. I am a bit worried about higher interest rates though, and my primary concern there is that the banks seem to be using it as an opportunity to enrich themselves rather than actually work with positively for customers. And if rates go up again, will the banks just use that as an opportunity to trouser the margin? No
one's actually said that rates do help older people, savers, and there are more savers than borrowers. And if you're on a fixed income, like a pensioner, then a lot of these other costs inflation really hurts you if you're on a fixed income. But if you have savings, it's the biggest tax in the world if you don't have savings with interest rates the same as inflation.
But if you look at the gap between the base rate and the actual rate that the banks are paying on those pensioner savings, there's a huge disconnect now, and that needs to be addressed. And the market doesn't seem to be keeping up with that.
Yes.
The competition in the market doesn't seem to be doesn't seem to be delivering the improved payouts to the savers.
So where are you landing? Are you pausing?
I think I'm on the fence, which is an uncomfortable place
very
to be.
rare for you, mate. Very rare. All right.
Yeah.
Okay, we'll give you a few more seconds to think about it. We'll go for the vote in a minute. Nick Pope, tell us about your business. You're actually making things and so on, aren't you? So a slightly different business. How's things for you?
Indeed, we are, Graham. Yeah, we're a manufacturing business based in Peterlee. We manufacture wastewater treatment tanks and liquid storage tanks, and it's interesting because about half the business goes to residential homeowners, and about half the business goes to big projects. So we've kind of got a bit of a handle on both. We're steady. What we're finding on the big project side, it's taking longer to get off the shelf for the customers. They're taking a lot more time. We're putting that down to project funding, so they're just kind of hedging their bets a bit. The residential side's been pretty okay. Again, though, interesting hearing guys on the panel. Typically, our products in the residential would go to relatively expensive properties, and we've heard that they seem to be holding up well, and the income side holds up well. Personally, I think one thing that makes me nervous is and again, Chris alluded to it, is I'm a bit cautious of a big bang effect of the interest rates coming through on homeowners, because so many are on fixed rates that I'm a bit nervous that we could see a very sudden slowdown. And yeah, everybody's been a bit surprised we haven't seen it yet. I'm kind of not surprised we haven't seen it yet, but I think it's coming. And the last thing we want is kind of a big dip and then interest rates coming down to try and recover it. So I would personally, on this one, I think I would pause for a little while and let's see what happens as the next 3, 4, 5 months unfold is my personal view.
There we are. So Chris, definitely not alone there on that one. I've got my say now because I'm panel number 9. I went and spent some time in America in the month of April. My daughter was getting married, but I did get to talk to people in business in America. I went to see someone who's involved with the Greater Philadelphia Chamber of Commerce. The American economy is storming ahead. There's clearly inflation built in. It's being driven by, strange enough, the Inflation Reduction Act, which Biden is using to pump prime American industry, which is driving a boom, whether it's sustainable or not. And the Fed is increasing interest rates to tackle inflation. So the thing that I thought when I was visiting America is that we are actually in an interest rates arms race, and if American rates are going up and European rates are going up and ours doesn't, we're going to import inflation with an effect on our exchange rate. Also, the thought about people on fixed incomes that David and I just discussed, it weighs on my mind. As someone in business, I think the right thing to do is pause. As someone on the panel thinking what's probably right for the country, I think the right thing to do is to grit our teeth and put it up another 0.25%. So I'm a riser. Right, let's have a vote, shall we? By show of hands, who thinks we should pause the interest rate rises? 2. Does anyone think we should lower interest rates? No. Does anyone think we should raise interest rates but by a significant amount of 0.5%? No. And does anyone think we should raise interest rates by a smaller amount, 0.25%? So not you. Oh, hang on, we've got an abstainer. What did David vote? Sorry, you're on mute.
I'm still not convinced either way.
Oh, come on, David.
If you need me to play my cards on the table, I would say we should hold.
Hold. All right. So it's a split decision. It's 3 people and 6, so 3-6, which is very much different to the last few Shadow MPCs where it's been more pronounced. Thank you everybody for joining us. I know that the Echo will write this up and Clive Owen will send you notes on it, but thank you very much indeed.